Alright, before we dive in, let's get the important legal stuff out of the way. I am not a financial advisor, a lender, or a real estate attorney. This presentation is for educational and informational purposes only. The world of real estate and finance changes constantly, so you must do your own research and consult with qualified professionals before making any financial decisions. This video should not be considered a substitute for professional advice. You found it. After months of scrolling through listings, driving down dusty backroads, and dreaming, you finally found the one. 10 acres of pure American potential. It's got a stand of old-growth oaks on the north end, a gentle slope perfect for a walkout basement, and a view that makes you feel like you're the only person on earth. You can already see it all so clearly. The long driveway, the porch swing catching the evening breeze, the workshop you've always wanted. This isn't just dirt. This is your future. This is your legacy. So you do what anyone would do. You pick up the phone, you call your bank, the same one that handles your checking account, maybe even your car loan, and you tell them you're ready. You found the land, and you need the loan to make it yours. And then you hear the hesitation on the other end of the line. A shuffling of papers. A throat clearing. And then the words that crush 1,000 dreams a day. Oh, for just land? I'm sorry, we don't really do that. That moment, that brick wall of rejection, is the exact reason this video exists. Because the single biggest myth in real estate is that getting a loan for land is anything like getting a mortgage for a house. It's not. It's a completely different game with different rules, different players, and much, much higher stakes. And thinking they're the same is the #1 mistake that costs aspiring landowners their dream property. But here's the good news. That's not going to be you. Not after you watch this. Over the next several minutes, I'm going to give you the complete playbook. We are going to pull back the curtain on the secretive world of land financing. I'm going to show you exactly why the big banks are terrified of lending on vacant land. We'll break down the different types of land loans that most people have never even heard of. I'll walk you through what lenders are really looking for so you can walk into their office looking like a seasoned pro, not a rookie. We're going to cover down payments, interest rates, and the hidden pitfalls that can turn your dream into a financial nightmare. By the end of this, you won't just understand how to get a land loan. You'll have a strategic roadmap to get the best possible deal on the path to owning your own piece of America. So let's start with the big question. Why are banks so scared of raw land? Why did that loan officer shut you down so fast? It boils down to one word: risk. For a lender, everything is about risk management. When you buy a house, the bank has excellent collateral. If you stop making payments, they can foreclose on a finished, livable home that has a relatively stable, easy-to-determine market value. They can sell it quickly to recoup their money. But land? Land is a different beast entirely. To a banker's spreadsheet, a piece of vacant land is pure speculation. It doesn't produce income. It doesn't provide shelter. Its value can swing wildly based on zoning changes, access to utilities, or development trends that might be years away. If you default on a land loan, the bank is stuck with an asset that can be incredibly difficult to sell. There's no house to list on Zillow. The pool of potential buyers is much smaller. It could sit on their books for years, a non-performing asset just bleeding money. Furthermore, a person buying a house is buying a primary need: shelter. They will fight tooth and nail, work 3 jobs, and sell everything they own to avoid being kicked out of their home. A person who bought a speculative piece of land out in the county? If a recession hits and they lose their job, that land payment is often the first thing to go. It's a want, not a need. The default rate on land loans is historically much higher than on traditional home mortgages. So, from the lender's perspective, they're taking on more risk with worse collateral for a borrower who is statistically more likely to default. When you see it through their eyes, it's no wonder they'd rather say no. But that doesn't mean it's impossible. It just means you have to go to the right lenders and speak their language. And the first word in that language you need to understand is the type of land you're actually buying. Because in the eyes of a lender, not all dirt is created equal. There are 3 main categories, and where your property falls will change everything about your loan options. First, you have what's called raw land. This is exactly what it sounds like. It's land in its most natural, untouched state. Think of a tract of timberland deep in the mountains, a desert parcel miles from the nearest paved road, or a hunting property with no road access. There are no utilities, no water, no sewer, no electricity, no gas lines. There might not even be a legal surveyed road leading to it. This is the riskiest category for a lender. It has no immediate use other than recreation or long-term speculation. Getting a loan for raw land is the heavyweight championship of land financing. It's tough, it requires a huge down payment, often 30 to 50%, and the interest rates will be significantly higher. Many traditional institutions won't even consider it. Next up the ladder is unimproved land. This is a big step up from raw land and is where most people buying residential lots will fall. Unimproved land may look raw at first glance, but it has some basic infrastructure nearby. It might be a subdivided lot in a rural community. The key difference is access. There's typically a road leading to the property, and utilities like electricity and water are available at the lot line or very close by on the main street. However, nothing has been connected to the property itself. There's no septic system installed, no well drilled, no driveway cut. The potential for development is obvious, which makes it less risky than raw land. Lenders are more comfortable with unimproved land, but they'll still want to see a solid plan and a healthy down payment, usually in the 20 to 35% range. Finally, we have the top tier, improved land. This is land that is ready to build on right now. It's often called a pad-ready or shovel-ready site. It has full utility access, water, power and sewer are already run directly to the building site. The land has been cleared, graded, and surveyed. A driveway might already be in place. It has a physical address. For a lender, this is the gold standard. The path from vacant lot to a finished home is short, clear, and far less speculative. You can get loans for improved land from more traditional banks. The down payments are lower, sometimes as low as 15 or 20%, and the interest rates are the most competitive you'll find in the world of land financing. Understanding these three categories, raw, unimproved, and improved, is the absolute foundation of your journey. Because when you call a lender, you won't just say, "I want to buy 10 acres. You'll say, "I'm looking to purchase a 10-acre, unimproved parcel with utility access at the road, and I need to understand your financing options for that specific type of property." That single sentence instantly changes the conversation. It tells the lender that you've done your homework, that you understand their world of risk, and that you are a serious, credible borrower. It moves you from the no pile to the let's talk pile. And that is the first most critical step to making that dream property a reality. So let's have that talk. Let's pull back the curtain on the types of loans that are actually available, because understanding the menu is the only way to know what to order. When you walk into a lender's office, you're not just asking for a land loan. That's like walking into a car dealership and saying, "I'll take one car, please." They're going to look at you confused and ask, "Okay, a sports car? A truck? An SUV?" The same is true for land. The type of land you're buying dictates the type of loan you'll get, the terms you'll face, and the difficulty of the entire process. Broadly speaking, there are three main categories of land, and each has its own unique financing world. Think of it as a spectrum from chaos to order, from wild to tame. And the wilder the land, the wilder the loan terms. The first and most challenging is a raw land loan. This is the final frontier. This is land in its most natural, untouched state. We're talking no utilities, no water, no sewer, no electricity. Often, there's no maintained road leading to it. You might need a four-wheel drive just to get to the property line. It hasn't been surveyed, subdivided, or zoned for any specific purpose. It is, for all intents and purposes, a blank and rugged canvas. From a lender's perspective, this is pure high-octane risk. Why? Because its value is almost entirely speculative. If you default on the loan, what are they stuck with? A patch of dirt in the middle of nowhere that they can't easily sell. It's not like a house, which has a clear market value and a large pool of potential buyers. Raw land is an illiquid asset. The bank might have to sit on it for years, or even decades, before finding a buyer willing to pay what they're owed. Because of this massive risk, lenders protect themselves with some very demanding terms. First, expect to bring a huge down payment to the table. We're not talking 3% or 5% like you might see with an FHA home loan. For raw land, you're looking at a minimum of 30%, and it's very common to see lenders demand 40% or even 50% down. They want you to have significant skin in the game. If you've put down half the money yourself, you are far less likely to walk away from the loan. Second, the interest rates will be significantly higher than a traditional mortgage. A home loan might be at 7%, but a raw land loan could easily be 9%, 10%, or even higher. Again, this is the bank pricing in the risk. They are charging you a premium for their gamble. And finally, the loan terms will be much shorter. You won't find a 30-year fixed-rate loan for a raw parcel of land. You're more likely to see terms of 5, 10, or maybe 15 years, often with a balloon payment. A balloon payment means you make smaller payments for a few years, but then the entire remaining balance of the loan becomes due all at once. The bank's assumption is that within that time, you will have either sold the land or developed it and refinanced into a different, more stable type of loan. A raw land loan is not a long-term relationship for the bank. It's a short-term, high-risk venture. So, who is a raw land loan for? It's for the patient visionary with deep pockets, the person who is buying a legacy property for their grandkids, or the savvy investor who sees a path for future development 10 years down the road. It is not for someone who wants to start building their dream home next summer. Now let's take one step in from the wilderness. The next category is an unimproved land loan. This is the middle ground, and it's where a lot of aspiring homesteaders and home builders find themselves. Unimproved land is a step up from raw land. It might have some basic infrastructure nearby. Maybe there's a gravel road leading to the property. Maybe utility lines, power, water, run along that road, but they haven't been connected to your specific parcel yet. The land has likely been surveyed and has clear, defined property lines. It might even be zoned for residential use. From the lender's point of view, the risk here is lower, but it's still very real. There's a clearer path to value. They can see that it's possible to build a house here without, say, spending $100,000 just to run power lines 5 miles through a forest. But the house doesn't exist yet. The utilities aren't hooked up. The septic system isn't installed. There are still many expensive and complicated steps before this land can host a home. Because the risk is lower, the terms get a little better. The down payment requirement typically drops. Instead of 50%, you might find a lender willing to work with 25% or 30% down. The interest rates will still be higher than a home mortgage, but probably a point or two lower than a raw land loan. The loan amortization might be stretched out a bit longer, perhaps over 15 or 20 years, making the monthly payments more manageable. You're still not likely to get a 30-year fixed, but the terms are far less intimidating. This type of loan is for the person who has a solid plan and a timeline. You know what you want to build, you've talked to the county about permits, you've gotten estimates from an excavation company. You are ready to start turning dirt into a home site within the next year or two. Finally, we arrive at the most civilized and lender-friendly category: an improved land loan. This is for land that is, for all intents and purposes, shovel-ready. This parcel is a builder's dream. It has legal maintained road access. The utilities are not just nearby. They are at the property line, ready for hookup. We're talking water, sewer, or a completed perk test for a septic system, electricity, and maybe even natural gas or fiber internet. The land has been surveyed, the corners are marked, and it is explicitly zoned for the single-family home you want to build. For a lender, this is a breath of fresh air. The risk here is dramatically lower. Why? Because the path from this improved land to a finished home is short, clear, and predictable. All the major infrastructure hurdles have been cleared. The value of the land is much easier to determine because it can be directly compared to other ready-to-build lots in the area. Because the risk is so much lower, the loan terms start to look much more like a traditional mortgage. Down payments can fall into the 15% to 25% range. Interest rates become much more competitive, getting closer and closer to standard home mortgage rates. And best of all, the loan terms can be much longer. It's not uncommon to find 15, 20, or even 30-year amortization schedules for improved land. This makes the monthly payment significantly more affordable, and the entire project more financially viable. This loan is for the person whose blueprints are finalized and whose builder is on standby. You're not buying a dream for the distant future. You are buying the foundation for a home you plan to break ground on in a matter of weeks or months. So you see, it's a spectrum. Raw land is high risk, demanding high down payments and tough terms. Unimproved land is medium risk, with more moderate terms. And improved land is the lowest risk, with loan terms that start to look comfortably familiar. Knowing where your target property falls on this spectrum is the key. It allows you to manage your own expectations, to prepare your finances accordingly, and most importantly, to walk into a lender's office and speak their language. You're no longer just asking for a car. You're telling them you're in the market for a specific model with specific features, and you know exactly what it's worth. Now that you understand the what, the 3 fundamental types of land and the loans that accompany them, we have to answer the most important question of all, the where. Where on earth do you actually go to get one of these loans? I'll give you a hint. It's almost certainly not the big national bank on the corner. In fact, if you walk into a Chase or a Bank of America and ask for a raw land loan, you'll probably be met with a polite but very firm no. So in the next part, we're going to uncover the hidden network of lenders who actually specialize in turning dirt into dreams, and I'll show you exactly how to find them. So let's pull back the curtain. This isn't about secret societies or knowing the right people. It's about knowing where the financial system has created specialized pockets for exactly this kind of lending. You see, the big national banks are like giant cruise ships. They are designed for one thing: sailing the deep, open waters of traditional home mortgages. They're stable, they're predictable, and they don't like to get too close to the shore. Asking them for a land loan is like asking the captain of that cruise ship to navigate a narrow, rocky river. They just aren't built for it. But what if I told you there's an entire fleet of smaller, more agile boats that know that river like the back of their hand? These are the lenders who thrive in the very waters the big banks are afraid of. Your first and most powerful ally in this search, especially if you're looking at a piece of land that's even remotely rural, is a group you may have never even heard of: the Farm Credit System. Now, don't let the name fool you. You don't have to be a farmer with 1,000 acres of corn to work with them. The Farm Credit System is one of the best-kept secrets in land financing. It's a nationwide network of borrower-owned financial institutions, which is a fancy way of saying they're like credit unions, but specifically for rural America. They were created by Congress over 100 years ago, with the explicit mission to support rural communities and agriculture. That is their entire reason for being. Think about the difference that makes. When you walk into a Bank of America, the loan officer is trained to see a house. They see square footage, number of bedrooms, comparable sales in the neighborhood. When you walk into a farm credit office, they see the land itself. They understand the value of timber on a wooded lot. They can assess the potential for a small hobby farm. They know the local water rights. They aren't just financing a property. They're financing a piece of the American landscape, and they know exactly how to value it. Their loan products are often called things like recreational land loans, country home loans, or lot loans. They are comfortable with large acreage, they are comfortable with properties that have a barn but no house, and they are comfortable with raw, undeveloped land because it's the core of their business. Finding them is surprisingly easy. Just go to your favorite search engine and type in Farm Credit, followed by the name of your state. You'll find institutions like Farm Credit Mid-America, AgFirst, or Plains Land Bank. Give them a call. You will be shocked at the difference in the conversation. Instead of a hesitant "let me see if we do that," you'll get a confident "absolutely, let's talk about the parcel." But what if your dream lot isn't a sprawling 20-acre homestead? What if it's a half-acre lot in a planned subdivision just outside the city? This is where our second type of lender comes in: the local and regional credit unions. These are the community champions. Unlike the national banks who see your town as a pin on a map, your local credit union sees it as their home. Their kids go to the local schools, they shop at the local grocery store, and they have a vested interest in seeing their community grow and prosper. This local knowledge is their superpower. A loan officer at a local credit union in, say, Western North Carolina, knows the difference between a buildable mountain lot and a scenic but impossibly steep cliffside. They know which areas have access to city water, and which will need a well and septic system. This intimate, on-the-ground knowledge means they can make lending decisions with a level of common sense that a computer algorithm in a skyscraper 1,000 miles away simply cannot. They are far more likely to have a specific land loan or lot loan product listed right on their website. And because they're smaller, you can often get a real human being on the phone, the actual person who will be looking at your file. You can explain your vision for the property, and they will listen. Their underwriting process can be more holistic, looking at you as a member of the community, not just a credit score. The key is to be strategic. Don't just search for credit unions. Search for your county credit union land loan or your city lot financing. Call their mortgage department and ask a simple question: do you offer financing for the purchase of vacant residential land? If they say yes, you've found a potential partner. Now, the first two options are fantastic, but they still involve working with a traditional financial institution. The third path is different. It's more direct, more creative, and for some people, it is the only way they can make their dream happen. I'm talking about seller financing. This is often called an owner will carry deal. And it's exactly what it sounds like. Instead of going to a bank for a loan, the person selling you the land becomes your bank. You make your payments directly to them. This can be an absolute game changer. Why would a seller do this? Lots of reasons. Maybe the property is unusual and difficult for a traditional bank to appraise. Maybe they want to receive a steady stream of income over several years for tax purposes. Or maybe they just want to sell the property quickly and are willing to be flexible to make a deal happen. The beauty of seller financing is that everything is negotiable. The down payment, the interest rate, the length of the loan, it's all a conversation between you and the seller. If you have a unique financial situation, maybe you're self-employed or have a recent blemish on your credit, a seller might be willing to look past that if you can offer a solid down payment and a clear plan. So how do you find these opportunities? You have to look for the signals. When you're searching on websites like Zillow, Land.com, or LandWatch, use their keyword search filter. Type in phrases like seller financing, owner will carry, or the abbreviation OWC. This will filter the listings down to only those sellers who have already advertised their willingness to make a deal. A good local land agent is also invaluable here. They often have inside knowledge of sellers who might be open to the idea even if it's not publicly listed. But, and this is the most important but of this entire video, you cannot do this on a handshake. If you pursue a seller finance deal, you must, without exception, hire a real estate attorney. They will draft the critical legal documents like a promissory note, which is your official promise to pay, and a deed of trust or mortgage, which secures the land as collateral. This protects you and it protects the seller. It turns a casual agreement into a legally binding, safe transaction. The rates might be a little higher than a bank's, but the flexibility and access it provides can be priceless. So there you have it. The hidden network isn't one place. It's 3 distinct pathways. The farm credit system, the giants of the rural landscape, local credit unions, the champions of community growth, and seller financing, the ultimate direct-to-the-source deal. You are no longer limited to the lenders who don't understand your vision. You now have a map to the ones who do. But finding the right lender is only half the battle. Now you have to convince them that you are the right borrower. You have to walk into that conversation prepared, professional, and ready to prove that you are a safe bet. Because when you're asking for a land loan, you're not just presenting numbers on a page. You're selling them on your dream. And in the next part, I'm going to give you the exact playbook on how to do it. We'll cover the 5 essential documents you must have ready before you even make the first phone call. And I'll reveal the one question you need to ask yourself that will instantly tell a loan officer whether you're a serious buyer or just a dreamer. Alright, let's dive straight into the 5 documents. Think of this as your financial battle armor. Showing up to a lender without these is like walking into a sword fight with a pool noodle. You're just not going to be taken seriously. First and most obviously is your proof of income. This is the bedrock of your application. Lenders need to see in black and white that you have a consistent and reliable stream of money coming in. This isn't just about your last 2 pay stubs, although you'll definitely need those. We're talking about the last 2 years of your financial life. That means your W-2s for the past 2 years if you're a traditional employee. If you're self-employed, a freelancer, or a business owner, get ready to provide your last 2 years of full tax returns, both personal and business. They'll also want to see a year-to-date profit and loss statement. Why so much? Because they're calculating one of the most important numbers in lending, your debt-to-income ratio, or DTI. This ratio tells them what percentage of your monthly gross income is already spoken for by other debts, car payments, student loans, credit card bills. Having this paperwork ready shows them you understand the game, and you're prepared to prove your ability to repay the loan. Second on the list is asset verification. This is where you prove you have the cash for the down payment and closing costs, but it's also much more than that. Lenders want to see your last 2 to 3 months of bank statements for all of your accounts, checking, savings, money markets. They're looking for a few key things here. First, the source of your down payment funds. They need to see that the money has been seasoned, meaning it's been sitting in your account for a while. A sudden massive deposit out of nowhere is a huge red flag. It could be an undisclosed loan from a friend, which is just another debt, and that spooks them. Second, they're looking for reserves. This is critical. After you pay your down payment and all the closing costs, do you have any money left over? Or is your bank account going to be at zero? Lenders want to see a cushion, typically a few months' worth of mortgage payments, sitting in reserve. It's your safety net, and it gives them immense peace of mind. So, gather every statement from every account you have. Don't hide anything. Transparency is your best friend here. The third document is your credit history. Now, I know you can go online and get a free credit score from a dozen different websites, and that's a good starting point to know where you stand. But understand this. The score you see is almost never the same score the lender sees. Most lenders use a specific FICO score model, often FICO score 2, 4, or 5. which are older, stricter models used specifically for mortgage lending. They weigh things differently than the consumer-facing VantageScore you get for free. So what should you do? You should absolutely pull your full credit report from all three bureaus, Equifax, Experian, and TransUnion, from the official government-mandated site, annualcreditreport.com. You're not looking just at the score. You're combing through the report line by line. Are there any errors? Any late payments you don't recognize? Any accounts that aren't yours? You need to dispute and fix these things before a lender ever sees them. A single error could be the difference between an approval and a denial, or it could cost you thousands in higher interest rates. Clean up your report. It's your financial resume, and it needs to be flawless. Number 4 is simple, but non-negotiable. Your personal identification. We're talking about a clear, unexpired copy of your driver's license or passport. You'll also need your social security number. This seems basic, but it's the step that officially allows the lender to pull your credit and verify that you are, in fact, who you say you are. Make sure the address on your ID matches the address on your application. Mismatched information, even small stuff, creates friction and delays. Get it right from the start. Finally, the 5th document, and this one is a bit of a chicken and egg situation, is the purchase agreement for the land. Now you might be thinking, how can I have a purchase agreement if I don't have a loan yet? And you're right. You likely won't have a fully executed, signed contract. But you need to show the lender you have a specific property in mind. This isn't a theoretical exercise. You need to provide, at a minimum, the property's address or parcel number, the asking price, and the seller's information. A draft of the purchase agreement is even better. Why? Because a land loan isn't like a personal loan for a vacation. The loan is secured by the land itself. The lender needs to evaluate the collateral. They need to know what they are lending on. Is it a 1-acre buildable lot in a subdivision? Or 100 acres of remote, inaccessible swampland? The details of the property are just as important as the details of your finances. Coming to a lender with a specific property in mind shows you're a serious buyer, not just a dreamer kicking tires. So you've gathered your W-2s, your bank statements, your spotless credit report, your ID, and the details of your target property. You've got them organized in a folder, digital or physical. You are now more prepared than 90% of the people who inquire about a land loan. But there's one more piece. It's not a document. It's the answer to a single question. The question a sharp loan officer will ask you, either directly or indirectly, to gauge your seriousness and the risk of the loan. The question is this: what is your specific, detailed plan for this land? And your answer cannot be, I don't know, or I just think it's a good investment, or maybe build a house on it someday. That is the kiss of death. Those answers scream high risk. A lender hears that and imagines a borrower who will stop making payments the second they run into a small problem, leaving the bank to foreclose on a piece of raw land they don't want. The answer that gets you approved, the answer that makes a loan officer lean forward and see you as a partner, sounds something like this. My plan is to build a 2,200 square foot, 3-bedroom home within the next 18 months. I've already spoken with 2 local builders to get preliminary cost estimates. I've personally visited the county planning and zoning department, and I have confirmation that the property is zoned residential and that there are no building moratoriums in the area. The seller has provided a recent survey and a past percolation test, so I know a septic system is viable. There's utility access at the road, and I've already gotten a quote from the electric co-op for running power to my planned build site. Do you feel the difference? It's the difference between night and day. That answer instantly tells the loan officer 3 crucial things. First, it proves you have done an incredible amount of due diligence. You haven't just fallen in love with pretty pictures online. You've investigated the practical and often boring realities of the property. You've identified and mitigated the biggest risks associated with raw land, zoning, septic, utilities. For a lender, risk is a 4-letter word. By showing you've eliminated these risks, you make their job 1,000 times easier. Second, it demonstrates an undeniable level of commitment. You've invested your most valuable asset, your time, into this project long before asking them for a dime. This signals that you're not going to flake out. You have momentum. You have a vision. You are a serious person who finishes what they start. Lenders would much rather loan money to someone with a slightly lower credit score but a rock-solid plan than to someone with a perfect score but a vague, flimsy dream. And third, it helps them place you in the right loan product. When they hear a detailed building plan, their mind immediately starts thinking ahead. Okay, this client needs a land loan now, but in 12 months they're going to need a much larger construction loan. We can structure this deal as a land loan that can be refinanced or converted into a construction to permanent loan later. You're not just asking for money. You're presenting them with a clear, profitable, long-term business opportunity. You've transformed yourself from a simple applicant into a valuable client. So before you ever pick up the phone, get your 5 documents in order, and then sit down and write out your detailed plan for the property. What are you going to do with it and on what timeline? Who have you talked to? What have you verified? Answering this one question with clarity and confidence is the single most powerful thing you can do to ensure your land loan application is a resounding success. Now that you're fully armed with the right paperwork and the right mindset to approach a lender, the next logical question is, which lender? Do you walk into the giant Bank of America on the corner? Or that small local credit union your neighbor belongs to? Are there specialized companies that only do land loans? The answer is yes to all of the above, and choosing the right one can save you an enormous amount of time, money, and heartache. Let's break down this labyrinth of lenders, because this is where dreams are either financed or forgotten. Think of it like choosing a guide for a treacherous expedition. You wouldn't hire a city tour guide to take you up Mount Everest, right? The same logic applies here. Choosing the wrong lender is like hiring that city guide. They might have a fancy website and a great sales pitch, but when you get to the real challenges, they're utterly lost. First up, we have the giants, the big national banks. The names you see on skyscrapers and during Super Bowl commercials. Wells Fargo, Chase, Bank of America. Your first instinct might be to walk into the branch you've used since you opened your first checking account. Feels safe, familiar. And for a standard home mortgage in a subdivision, they can be a fine, efficient choice. But for a raw land loan? More often than not, it's a recipe for frustration. Here's the unfiltered truth. Most big national banks hate, and I mean hate, raw land loans. To them, raw land is a speculative, high-risk, non-conforming asset. It doesn't fit neatly into the automated underwriting software that approves 99% of their loans. There's no house on it, which means in their eyes there's less collateral and a higher risk of you just walking away if things go south. The person making the final decision on your loan, the underwriter, is likely sitting in a cubicle 1,000 miles away. They've never seen your town, they don't know that the proposed new bypass is going to make your parcel a prime location, and they have zero emotional connection to the local market. They see a set of numbers on a screen, and if those numbers don't fit into their very small, very rigid box, the answer is an automatic, computer-generated no. I heard a story about a couple in rural Tennessee. They found 10 perfect acres. Creek, old-growth trees, road access, good perk test. They had a 40% down payment and 800 credit scores. They went to their big national bank, the one that held their life savings, and applied. Weeks turned into a month. The bank asked for survey after survey, document after document. The local branch manager was sympathetic, but his hands were tied. The final decision came from an underwriting center in another state. Denied. The reason? Collateral is not in a developed area and lacks marketability. They were heartbroken. That land is now worth 3 times what they would have paid for it. The big bank's algorithm completely missed the reality on the ground. For them, it's not about your dream. It's about a transaction fitting a predetermined risk profile. And raw land almost never fits. So who do you turn to? This brings us to the heroes of our story. Local and regional banks. The community bank on Main Street. The one whose name is on the Little League jerseys. These institutions are a completely different animal. Their business model is built on community knowledge and relationships, not algorithms. When you walk into a local bank to talk about a land loan, you're often talking to someone who lives just a few miles from you. The loan officer might even drive by the parcel on their way home. They understand the local economy, the zoning quirks, and the future development plans. They have a vested interest in seeing their community grow and thrive. The magic words you're looking for here are portfolio loan. Big banks almost always sell their loans on the secondary market to giants like Fannie Mae and Freddie Mac. To do this, the loans must conform to a strict set of national standards. But local banks often keep their loans in-house, on their own books. This is a portfolio loan, and it gives them incredible flexibility. They get to set their own rules. They can look at your 40% down payment, your solid credit, and the beautiful piece of land, and they can make a common-sense decision. They can see the story behind the numbers. They can understand that you're a local teacher building a forever home, not some faceless speculator. Their underwriting is done by a human being who understands that not every valuable piece of property is in a pre-approved subdivision. The rates might be a quarter point higher, and their mobile app might look like it was designed in 2008, but they will actually get the deal done. And what about credit unions? Think of credit unions as local banks on overdrive. They are nonprofit cooperatives owned by their members. Their entire reason for existing is to serve their members, not to generate profit for distant shareholders. This often translates into some of the best rates and lowest fees you'll find anywhere. They have that same local knowledge and portfolio lending flexibility as a community bank, but with an even greater focus on member service. The only catch with a credit union is that you have to be eligible to join. Membership is usually based on a field of membership, which could be tied to your employer, the county you live in, your profession, or even being related to a current member. But don't count yourself out too quickly. Many credit unions have very broad membership requirements. It is absolutely worth your time to research the credit unions in the area where you're buying land. A few phone calls could literally save you thousands of dollars over the life of the loan. Now let's get into the pro leagues, the specialists, the lenders that most amateur land buyers have never even heard of. I'm talking about the Farm Credit System. This isn't one single bank. The Farm Credit System is a nationwide network of borrower-owned financial institutions, chartered by the U.S. Congress way back in 1916. Their specific mission is to provide sound and reliable credit to American agriculture and rural communities. Buying land is what they do. It is their entire world. Names like Farm Credit East, American Accredit, or Ag First aren't household names unless you're a farmer. But for a land buyer, they are pure gold. If you are buying anything over 5 acres, if the property is zoned for agriculture, if it has a barn on it, or if it's just plain rural, you need to call them. Period. These lenders live and breathe land. Their loan officers, who are more like expert consultants, understand soil types, timber value, water rights, and conservation easements. They won't be scared off by large acreage. In fact, they prefer it. They won't blink at an odd-shaped parcel or a property with no utilities yet. This is their normal. Because they are specialists, they offer loan products you won't find anywhere else. They can offer longer amortization periods, sometimes up to 30 years for bare land, which dramatically lowers your monthly payment. They can structure loans with flexible payment schedules to match a farmer's income. And because they are also a cooperative, they often pay out patronage dividends at the end of the year, which is essentially a refund on some of the interest you paid. It's like getting a check back from your bank. So, how do you put all this information into action? It's simple. You create a strategy. Don't just walk into one bank and hope for the best. Start local. Your first call should be to at least 3 local community banks and 3 local credit unions in the county where the land is located. Ask them one simple question right up front. Do you offer portfolio loans for raw, undeveloped land? If they say yes, you're in the right place. If they hesitate or say, we have to send it out for approval, be wary. Simultaneously, if your property fits the rural or agricultural description, find your regional farm credit institution. Go to their website, find the local office, and make the call. You will be amazed at the level of expertise you encounter. Notice who I left for last? The big national banks. Don't even waste your time with them unless you've exhausted all other options, or you have a very unique relationship with a private banker there. The odds are stacked against you from the start. By following this strategy, local first, specialist second, and giants last, you move from being a hopeful applicant to a savvy shopper. You create competition for your business. You'll be comparing real offers from lenders who actually want to make your loan, not just trying to find one who will reluctantly say yes. But finding the right lender is only half the battle. Now you have to actually apply. You need to prepare a package so professional, so complete, that it makes their yes an easy one. You need to know exactly what documents they're going to ask for before they even ask. And more importantly, you need to know the hidden red flags in an application that can get you instantly denied, no matter how good your credit is. And that's exactly what we're going to break down next. So let's pull back the curtain on the loan underwriter's desk. Imagine this person has a stack of 100 applications. Their job isn't to be your friend. Their job is to protect the bank's money. They are professional risk detectives, trained to spot inconsistencies, weaknesses, and potential defaults from a mile away. Your application isn't just a form. It's a story. And if that story has plot holes, unexplained characters, or a weak ending, it's going straight into the denial pile. Your mission, should you choose to accept it, is to write a story so compelling, so airtight, that they have no choice but to say yes. We're going to break this down into 3 core pillars the lender is examining: your identity, your income, and your intent. Get these 3 right and you're 90% of the way there. First, the easiest one, identity. This seems basic, but you'd be shocked how many people trip at the starting line. They'll need government-issued photo ID, like a driver's license or passport. The hidden red flag here? Inconsistency. Does the name on your ID exactly match the name on your bank statements, your tax returns, and the application itself? Is it Jonathan Smith on one and John Smith on another? Is your address current and does it match what's on your utility bills? Underwriters are paid to notice these tiny details. A mismatch isn't just a typo. To them, it's a potential sign of fraud or, at best, a sign of carelessness. And if you're careless with your own name, how will you be with their money? So, before you submit a single page, do a consistency audit across all your documents. Make sure your story is straight from page 1. Now for the big one, income. This is where most applications live or die. The lender's core question is simple: can you actually afford this loan? But how they answer that question is incredibly complex. Let's split this into 2 paths: the W-2 employee and the self-employed entrepreneur. If you're a W-2 employee with a steady job for the last 2+ years, your life is relatively simple. You'll need your 2 most recent pay stubs, your last 2 years of W-2s, and your 2 most recent federal tax returns. The lender is looking for stability. They want to see a consistent, predictable income stream. The red flag here? A recent major job change, especially if it's to a completely different industry or involves a switch to a commission-based salary. If you went from being a salaried accountant for 5 years to a 100% commission real estate agent 2 months ago, that's a massive red flag. You haven't proven that new income is stable. They also scrutinize your pay stubs for heavy use of overtime. If 40% of your qualifying income is from overtime that isn't guaranteed, they might not count all of it. They want to approve a loan based on your reliable base income, not on a temporary surge of extra hours. Now, for my self-employed people, the freelancers, the small business owners, listen up because this is critical. The bank views you as inherently riskier. Your income isn't guaranteed by a major corporation. It's guaranteed by you. So the level of scrutiny is 10 times higher. You'll need, at a minimum, your last 2 years of business and personal tax returns. All schedules, all pages. You'll also need a year-to-date profit and loss statement, or P&L, and your last several months of business bank statements. Here's the number 1 mistake self-employed people make: the instant denial trap. You spent all year trying to show the IRS you made as little money as possible, and now you're trying to show the bank you made as much money as possible. You can't have it both ways. The lender doesn't care about your gross revenue. They don't care if you invoiced $1 million. They care about one number: your net income after all your business write-offs. The number you actually pay taxes on. If you wrote off everything under the sun, your car, your home office, every single meal, and your tax return shows you only had a net profit of $30,000, then in the bank's eyes, you are a person who makes $30,000 a year. Period. The other massive red flag is erratic cash flow. They will analyze your bank statements line by line. Are you seeing huge deposits followed by long dry spells? That looks unstable. And the kiss of death? Large, unexplainable cash deposits. A $10,000 cash deposit out of nowhere looks like you borrowed money from a friend for the down payment, which is a huge no-no, as it's an undisclosed debt. Or worse, it looks like illicit income. Every single large, non-payroll deposit will need to be sourced and explained with a paper trail. If you can't prove where it came from, the lender will disregard it entirely. Be prepared to write letters of explanation for anything that looks even slightly unusual. The final pillar, and the one that's unique to land loans, is intent. With a house loan, the intent is obvious. You're going to live in the house. With raw land, the possibilities are endless, and that scares a lender. I might build a cabin someday is not a business plan. It's a dream. And banks don't lend on dreams. They lend on plans. You need to present a clear, well-researched vision for the property. This is your chance to shine and show them you are a serious, low-risk investment. Your letter of intent is your secret weapon. This document should clearly state your plans. Are you building a primary residence? A vacation home? Are you holding it for investment? Be specific. If you plan to build, you need to prove you've done your homework. Have you checked the zoning regulations? Is the property zoned for what you want to build? Include a copy of the zoning report. Have you had a perk test done to ensure you can install a septic system? Include the results. Do you know if you can get utilities to the site? Show them proof you've spoken with the local power and water companies. Even better, Get preliminary quotes from a builder. You don't need a full-blown contract, but showing the lender a realistic cost estimate to build demonstrates that you understand the full financial scope of the project, not just the cost of the land. Compare two applicants. Applicant A says, "I love this land and I hope to build on it in a few years." Applicant B submits a package that says, "Here is the 10-acre parcel. It is zoned AG residential. Here is the past perk test from the county health department. Here is a letter from the electric co-op confirming service can be run for approximately $8,000. And here are two preliminary bids from local builders for a 2,000 square foot home, with an estimated construction cost of $450,000. We plan to break ground in 18 months. Who do you think is getting the loan?" It's not even a contest. So, to recap the hidden red flags that get you instantly denied: inconsistent personal information across documents, a brand new job in a different industry, trying to qualify using non-guaranteed overtime or commission you haven't been earning for at least 2 years. For the self-employed, showing a low net income on your tax returns after massive write-offs, large undocumented cash deposits in your bank accounts, and finally a vague undefined plan for what you intend to do with the land. Your application is your business plan to the bank for the biggest investment of your life. Treat it with that level of professionalism. Gather your documents, check them for consistency, understand your numbers inside and out, and craft a compelling story of your intent. Because a great application doesn't just answer the lender's questions, it anticipates them. It makes the underwriter's job easy. It makes them want to approve you. It transforms you from just another number in a stack to a credible, trustworthy partner. Now, once you have this perfect package assembled, you're ready to face the next crucial hurdle: understanding the different types of land loans that are available. Because not all land is the same, and the financing for a raw, undeveloped parcel in the middle of nowhere is wildly different from a fully developed lot in a subdivision. Choosing the wrong loan product can cost you thousands in fees and interest, or even lead to a denial for a property you could have otherwise afforded. And that's the critical choice we need to break down next. So let's wade into these financial waters together. Think of this as choosing your vehicle for a cross-country road trip. You wouldn't take a sports car on a rugged mountain trail, and you wouldn't take a massive RV into a crowded city center. The loan you choose is your vehicle, and the land you want is your destination. The match has to be perfect. Let's start with what is often the most accessible, and also the most misunderstood, path: seller financing. This is also known as owner financing. In simple terms, instead of going to a bank, you're making a deal directly with the person who owns the land. They become your lender. You give them a down payment, and then you make monthly payments directly to them with interest over an agreed-upon term. It sounds simple, right? And sometimes it is. The biggest pro of seller financing is flexibility. The property owner isn't bound by the same strict federal regulations and underwriting rules as a bank. Maybe your credit score is a little bruised. Maybe your income is from a new freelance business that banks don't understand yet. A seller might be willing to look past those things and see you as a person. They might be more flexible on the down payment, the interest rate, and the length of the loan. For many people trying to get their foot in the door of land ownership, seller financing is the only key that fits the lock. It can turn a no from a bank into a yes from an individual. But, and this is a massive but, that same flexibility is also its greatest danger. Because there's less regulation, there's more room for things to go wrong. You are entering a financial agreement not with a multi-billion-dollar institution with a whole legal department, but with an individual. This is where you absolutely positively cannot cut corners. The interest rates in seller financing are often significantly higher than a bank's. The seller is taking on all the risk, and they will price that risk into your rate. Don't be surprised to see rates that are several points higher than what a traditional lender would offer. You also have to be hyper-vigilant about the terms of the deal. Is there a prepayment penalty if you want to pay it off early? What happens if you're late on a payment? Is there a balloon payment? A huge lump sum due at the end of the loan term that could force you to sell or refinance. These are traps for the unwary. This is not a handshake deal. This is not a good faith agreement. Every single detail must be documented in a legally binding promissory note and a mortgage or deed of trust recorded with the county. And you must, I cannot stress this enough, have a qualified real estate attorney review every single word of that contract on your behalf. Not the seller's attorney. Your attorney. Paying a lawyer a few $100s to review the paperwork could save you tens of thousands of dollars and your entire investment down the road. Seller financing can be a fantastic tool, but you have to go into it with your eyes wide open and with professional legal protection. Okay, so what if you'd rather deal with a more traditional institution? Let's talk about getting a loan from a bank or a credit union. This is where that distinction between raw land and improved land becomes the single most important factor. From a lender's perspective, these are two completely different worlds. Let's start with the Wild West. Raw land loans. This is for that untouched parcel. No utilities, no road, no sewer, no permits. Just potential. And to a bank, potential is just another word for risk. Extreme risk. Think about it from their chair. If they lend you money for a house and you default, they can foreclose on the house. A house is a relatively easy asset to sell. But a piece of raw, undeveloped land? That's much harder. There's a smaller pool of buyers. Could sit on their books for years. Because of this high risk, banks protect themselves with very strict terms. First, expect a massive down payment. We're not talking 3% or 5% like on a house. For a raw land loan, lenders will typically demand anywhere from 30% to as high as 50% down. If you're looking at a $100,000 parcel, you need to be ready to walk in with $30,000, $40,000, even $50,000 in cash. Second, the loan terms will be much shorter. A typical home mortgage is 30 years. A raw land loan? You'll be lucky to get 15 years. More common are terms of 5, 7, or 10 years. This means your monthly payments will be significantly higher. And third, the interest rate will be higher. Again, the bank is pricing in their risk. You'll pay a premium for the privilege of them lending on an asset they consider speculative. Getting a raw land loan is tough. Many big national banks won't even touch them. You'll have much better luck with smaller, local community banks and credit unions. They have a better understanding of the local land market and may be more willing to take on that risk. Now let's move to the much friendlier side of the street. Improved land loans. This is for a lot that's ready or almost ready to be built on. It has legal road access. Utilities like water, electricity, and sewer are at the property line or already connected. It's been surveyed, and it's zoned for residential construction. To a bank, this is a completely different ballgame. The risk has been drastically reduced. Why? Because the most expensive and complicated parts of development are already done. This land isn't just potential anymore. It's a product. It's a defined, valuable asset that is far easier for the bank to sell if you default. Because the risk is lower, the terms get better. The down payment requirement will drop, often into the 20% to 25% range. Still more than a house, but much more manageable than 50%. The loan terms might get a little longer, and the interest rates will be more competitive, closer to, but still likely higher than, a standard home mortgage. You're being rewarded for buying a less speculative asset. This is why all that due diligence we talked about earlier is so important. Proving to a bank that your lot is improved and build-ready is your ticket to a much better loan. Finally, there's a third path, a specialized one that many people overlook: government-backed loans. The most prominent player here is the USDA, the United States Department of Agriculture. Specifically, we're talking about the Section 523 Rural Housing Site Loan. This is a very targeted program, but if you qualify, it's an absolute game-changer. These loans are designed to help low and very low-income families purchase and develop building sites in rural areas. The government's goal is to promote homeownership outside of major cities. The benefits are incredible. We're talking about interest rates that can be astonishingly low. The loan term is short, just 2 years, but here's the magic. The USDA expects you to build a home on that land within those 2 years, often using their other loan programs like the Section 502 direct loan. The land loan essentially gets rolled into your permanent construction and home loan. Now the catch. The eligibility requirements are very strict. You must meet specific low-income thresholds for your area. The property must be in a designated rural area, which you can check on the USDA's website. And you must be unable to get credit through other means at reasonable rates and terms. This isn't a program for land speculators or people building a luxury vacation cabin. It's for hardworking families who need a helping hand to build a modest, primary residence. The application process can be long and paperwork intensive, but for the right person in the right situation, a USDA site loan can make the impossible possible. So you have these 3 main roads to choose from: the flexible but risky path of seller financing, the more traditional but demanding route of a bank loan, or the specialized, narrow trail of a government program. Each has its own rules, its own costs, and its own destination. Choosing the right type of loan is the strategic first half of the battle. It's about aligning your financial reality with the reality of the land you want to buy. But once you've picked your path, the journey's not over. Now you have to actually walk it. You have to assemble your documents, present your case, and convince an underwriter that you are a risk worth taking. You need to build a bulletproof application that a lender simply can't say no to. And that process, that art of getting approved, is exactly where we're going next. So let's build it. Let's forge that application. This isn't just about filling out forms, it's about building a case. You are the lawyer, the lender is the judge, and the underwriter is the jury. Your financial life is the evidence. Your goal is to present this evidence so clearly, so compellingly, that the verdict is a foregone conclusion. Approved. Before you even speak to a loan officer, your work begins. This is the pre-game. This is where you win or lose the loan, often before the application is even submitted. The first and most critical piece of evidence is your credit score. For a standard home mortgage, lenders might be a little flexible. For a land loan, they are ruthless. A high credit score doesn't just say you pay your bills on time. It tells a story of financial responsibility over years. It screams low risk. Lenders will pull reports from all three major bureaus, Equifax, Experian, and TransUnion, and they typically use the middle of the three scores. You should be aiming for a score of 720, and ideally 740 or higher. Anything less, and you're starting the race with a limp. So, step 1 right now is to pull your credit reports. Go through them with a fine-tooth comb. Are there any errors? A bill you paid off that's still showing as delinquent? A credit card that isn't yours? Dispute every single inaccuracy. This can be a game changer. Next, look at your credit utilization. That's the percentage of your available credit that you're currently using. If you have a credit card with a $10,000 limit and a $5,000 balance, your utilization is 50%. To a lender, that looks like you're stretched thin. Your mission is to get that utilization below 30% on every single card, and ideally below 10%. Pay down those balances aggressively before you apply. This one action can boost your score significantly in just a month or two. Now for the second pillar of your case, your debt-to-income ratio, or DTI. This is the metric underwriters obsess over. It's simple math. You take all of your monthly debt payments, car loans, student loans, credit card minimums, any other mortgages, and you add your proposed new land payment to that total. Then you divide that number by your gross monthly income before taxes. The result is your DTI. For example, if your total monthly debts, including the new land loan, would be $2,000, and your gross monthly income is $6,000, your DTI is 33%. For a land loan, lenders want to see that number as low as possible, while a conventional home loan might allow a DTI up to 43% or even higher. For a raw land loan, many lenders draw a hard line at 36 to 40%. Why? Because they know you're not just buying land. You're probably going to build on it eventually, which means taking on a massive construction loan later. They need to be absolutely certain you have the breathing room in your budget to handle this current loan without breaking a sweat. So calculate your DTI. If it's high, your only options are to decrease your debt by paying things off or increase your income. The third and arguably most important pillar is cash. Cold hard season cash. We've said it before, but it bears repeating. Land loans require a significant down payment. 20% is often the absolute minimum, but you should be prepared for 30, 40, or even 50%, especially for raw, unimproved land. This isn't just about reducing the lender's risk. It's about you demonstrating serious commitment. It's you putting a massive amount of your own skin in the game. But it doesn't stop with the down payment. Lenders want to see cash reserves. These are funds you have left over after you've paid your down payment and all your closing costs. They want to see that you have enough liquid cash in the bank to cover several months, often 6 months or more, of the land loan payments, property taxes, and any HOA or POA dues. This is your safety net. It proves that if you lost your job the day after closing, you wouldn't immediately default. So, when you're saving, you're not just saving for the down payment. You're saving for the down payment plus closing costs plus a hefty reserve fund. Once you have your credit, DTI, and cash in order, it's time to assemble your arsenal of documents. This is the paperwork that backs up every claim you make. Get a folder, digital or physical, and start gathering. First, the basics: proof of identity. A clear copy of your driver's license or passport for you and any co-borrowers. Simple. Second, proof of income. This is the big one. If you're a W-2 employee, You'll need your most recent pay stubs covering a 30-day period. You'll need your W-2 forms from the past 2 years. And you will need complete, signed federal tax returns for the past 2 years, every single page. If you are self-employed, a freelancer, or a business owner, the scrutiny intensifies. You'll need the last 2 years of your personal and business tax returns. You'll also need a year-to-date profit and loss statement and a balance sheet for your business. The lender is going to analyze your business's health as much as your personal finances. They want to see stable or, ideally, increasing income over that 2-year period. Third, proof of assets. This is where you prove you have the cash for the down payment, closing costs, and reserves. You'll need bank statements for the last 2 to 3 months from every single account you have: checking, savings, money market. And I mean every page, even the blank ones. Lenders are legally required to have them. They are looking for something called sourced and seasoned funds. This means the money has been in your account for a while. If you have a huge recent deposit, say $20,000 from a family member, you will have to provide a signed gift letter and document the source of those funds. They need to ensure it's a gift, not an undisclosed loan. You'll also need statements from any investment or retirement accounts, like your 401k or brokerage accounts, to show your full financial picture. Now for the land-specific documents. This is what separates a land loan application from a regular mortgage. You will need a fully executed copy of the purchase agreement, signed by both you and the seller. You'll need a copy of the land survey, which clearly shows the property boundaries, easements, and any encroachments. You will need the results of a successful percolation test, or perk test, if the property requires a septic system. This proves the soil can absorb water and is suitable for building. You'll need documentation on water access, whether it's a connection to city water or the results of a well drilling test. You'll need to provide the zoning classification for the property from the county or municipality, confirming that you can legally use the land for your intended purpose. And critically, you need proof of legal, year-round access to the property. If your access is via an easement over a neighbor's land, the lender will want to see that legal easement agreement. With all this evidence compiled, there's one final powerful step you can take. Write a letter of explanation. This is your opening statement to the jury. It's a one-page cover letter for your entire application. In it, you briefly and professionally introduce yourself. You state your intentions for the property. Are you building your dream primary home, a family vacation cabin, or holding it as a long-term investment? Be specific. If you have any blemishes in your financial history, a late payment a few years ago due to a medical emergency, a short gap in employment, address it head-on. Explain it briefly and take responsibility. Don't make excuses. Finally, show them you've done your homework. Mention the successful perk test, the confirmed zoning, and the clear access. This letter transforms you from a stack of papers into a real person. A prepared, responsible, and serious borrower who understands the gravity of this investment. You've built your case, submitted your evidence, and now it's in the hands of the jury, the underwriter. They're going to come back with one of 3 verdicts: an approval, a denial, or the dreaded conditional approval. Understanding what those conditions are, how to satisfy them, and how to fight for the best possible terms on your loan is the final battle in this process. And that's the battle we'll prepare for next. The loan officer calls. Your heart leaps. They say the words you've been waiting to hear for weeks. You're approved. You want to celebrate, call your family, post on social media. But then they add 2 little words that change everything. Conditionally approved. This is not the finish line. This is the final treacherous maze before you get the keys. Conditional approval is the lender's way of saying, we want to give you this money. We think this is a good deal. But first you have to prove it. You have to run our gauntlet of final demands. This is where more land deals fall apart than any other stage. It's where buyers get complacent, make a wrong move, and watch their dream property slip through their fingers just days before closing. So what are these conditions? Think of them as the lender's last-minute checklist to eliminate every single shred of risk. The underwriter, who has been a mysterious figure up to this point, now becomes the most important person in your life. They are the final gatekeeper, and they have a list. The first and most common condition is the final verification of employment. This catches so many people off guard. You might think, they already verified my job weeks ago. They don't care. They will call your employer, sometimes the day before closing, to make sure you are still employed and your income hasn't changed. I have heard absolute horror stories about this. The buyer who, feeling secure with their approval, decides to quit their job to start their own business a week before closing. The deal instantly implodes. The buyer who accepted a promotion that changed their pay structure from salary to commission-based, voiding their income qualification. The rule is simple. Until the deed is in your hand and the wire has cleared, you do not change a single thing about your financial life. Don't quit your job. Don't change jobs. Don't even think about it. Next up is the appraisal condition. This is a massive one for land. The lender will only loan you money based on the appraised value of the land, not necessarily the price you agreed to pay. The condition is that the land must appraise for at least the purchase price. So what happens if you agreed to pay $100,000, but the appraiser comes back and says it's only worth $90,000? You now have a $10,000 gap. The lender will only finance based on that $90,000 value. This triggers a frantic three-way negotiation. Option 1. You, the buyer, have to come up with an extra $10,000 in cash to cover the difference. Option 2. The seller has to agree to lower the price to $90,000. Option 3. You meet somewhere in the middle. Or if no one can agree, the deal dies right there. A low appraisal can feel like a catastrophe, but it can also be a powerful negotiation tool to get a better price. Then we have the title and survey conditions. The lender will demand a final title report showing that the property has a clear title. This means there are no other claims, liens, or ownership disputes on the property. This is where hidden problems crawl out of the woodwork. An old unpaid contractor's lien from a previous owner, a long-lost heir who suddenly has a claim to the property, or the most common issue for rural land, unresolved easements. The survey might reveal a utility company has a 20-foot easement running right through the middle of your perfect building site, meaning you can't build there. Or your neighbor's fence is actually 5 feet onto your property. These issues must be legally resolved or cured before the lender will release the funds. This can take weeks, sometimes months, of legal wrangling, and it's a condition that must be satisfied. Another critical condition is the sourcing and seasoning of your funds. The lender wants to see proof that you have the money for your down payment and closing costs, and they want to know exactly where it came from. You can't just show up with a suitcase of cash. They will scrutinize your bank statements from the last several months. They're looking for large, unexplained deposits. That $20,000 your parents gifted you for the down payment? It needs a signed gift letter stating clearly that it's a gift, not a loan that needs to be repaid. Why are they so strict? 2 reasons. First, they need to ensure you're not taking on more secret debt to close the deal. Second, they are legally required to comply with anti-money laundering laws. A sudden large cash deposit looks like a massive red flag. Your funds need to be seasoned, meaning they've been sitting in your account for a while, typically at least 60 days. But satisfying these conditions is only half the battle. The other half is scrutinizing the lender's final offer. Just before closing, you will receive a document called the closing disclosure. This is one of the most important documents you will ever sign. By law, you must receive it at least 3 business days before your scheduled closing. This is your final chance to review every single number. You need to compare it line by line with the loan estimate you received at the beginning of the process. Are the numbers the same? Pay close attention to the loan costs section. This is where lenders can sneak in what are often called junk fees. Look for vague terms like processing fee, underwriting fee, document preparation fee, or funding fee. Many of these are just different names for the cost of doing business, and they are often negotiable. Ask your loan officer to explain every single fee. If they can't give you a clear, concise answer for what a fee is for, challenge it. You can often get hundreds, sometimes even thousands of dollars in these fees waived just by asking tough questions and showing you've done your homework. This is also your last chance to confirm your interest rate lock. In a volatile market, an interest rate can change daily. A rate lock is a guarantee from the lender that they will honor a specific interest rate for a set period, typically 30 to 60 days. Did you lock your rate? Is the rate on the closing disclosure the same as the rate you locked? Is the lock set to expire before your closing date? If it is, the lender will likely charge you a hefty fee to extend it. This is a critical detail to manage. And finally, you must hunt for one of the most dangerous clauses in a land loan: a prepayment penalty. This is a fee the lender charges you if you pay off your loan too early. They exist because lenders make their money on the interest you pay over time. If you pay it off in 2 years instead of 15, they lose out on 13 years of profit. For a land loan where your plan might be to pay it off quickly once you build a house and refinance, a prepayment penalty can be absolutely devastating. costing you thousands of dollars for being financially responsible. Demand to know if your loan has one. If it does, fight to have it removed. If they won't remove it, try to negotiate the terms, for example, a penalty that only applies for the first 2 or 3 years, not the entire life of the loan. Some lenders will offer a slightly lower interest rate in exchange for a prepayment penalty. Almost always, this is a bad trade. Take the flexibility. Once you have satisfied every condition from the underwriter, and you have reviewed and approved every line item on the closing disclosure, you will finally hear the 3 most beautiful words in real estate. Clear to close. This is the official green light. It means the underwriter has signed off, the legal team has signed off, and the funds are ready to be wired. The battle is over. The maze is complete. Now all that's left is to schedule the closing, sign your name on a mountain of paperwork, and finally take possession of your own piece of America. The closing table. It's the final boss level of real estate. You'll sit down, likely in a sterile office at a title company or a lawyer's office, and before you will be a stack of paper so thick it could stop a small caliber bullet. This is it. The culmination of every phone call, every email, every moment of anxiety and every flicker of hope. And your only weapon is a pen. You'll start signing, and signing, and signing. Your signature, which you've known your whole life, will start to look like a bizarre forgery. You'll sign documents you barely understand, attesting to things you've been told are true. The note, which is your personal promise to repay the massive loan. The deed of trust or mortgage, which gives the lender the right to take your land if you break that promise. Disclosures about floodplains, lead paint if there's a structure, and a dozen other CYA documents for everyone involved. The closing agent will slide pages in front of you, pointing with a perfectly manicured finger, saying sign here, initial here, date here. It's a blur. But somewhere in that blur, a transfer happens. Wires are confirmed. Funds move through the invisible arteries of the financial system. The seller gets their money, the lender gets their lien. And you? You get a small, unassuming manila folder with copies of everything, and maybe, just maybe, a set of keys to a gate. You walk out of that office blinking in the sunlight. Feels anticlimactic. Surreal. You just signed your name to the biggest financial commitment of your life, and the world outside looks exactly the same. But it isn't. Because now you are a landowner. The first drive out to your land after closing is a pilgrimage. It's different this time. You're not a visitor. You're not a prospective buyer. You are the owner. You step out of your car and the air feels different. The sound of the wind in the trees is a welcome, not a warning. You place your hand on a tree and it's your tree. You scoop up a handful of dirt and it's your dirt. This is the moment it becomes real. This is the payoff. But don't get lost in the romance just yet. The work is just beginning, and the first 90 days of land ownership are critical. Your first mission, should you choose to accept it, is to become the undisputed expert on your own property. Walk the perimeter. Again, this time with the official survey plat in hand. Find the corner markers. They might be iron pins, concrete monuments, or even old stone piles. If you can't find them, or if the survey is old, your very first investment should be hiring a surveyor to mark them clearly. This isn't optional. It's foundational. Boundary disputes are the stuff of rural legend and can turn into bitter, decade-long legal battles with your new neighbors. Settle it now. Know with absolute certainty where your land ends and theirs begins. While you're at it, introduce yourself to those neighbors. Don't be shy. These are the people who will notice a strange truck on your property when you're not there. They're the ones who know the local history, who can tell you where the water pools after a heavy rain, or which part of the woods the deer prefer in the winter. Building good relationships from day one is invaluable. Bring a pie, a six-pack, a friendly wave, it goes a long way. Next, it's back to the paperwork. You'll receive the original recorded deed in the mail. This is one of the most important documents you will ever own. Do not, I repeat, do not just toss it in a drawer. Make digital copies and store the original in a fireproof safe or a bank safe deposit box. This is your official proof of ownership. You also need to get intimately familiar with your new best friend, the county tax assessor's office. You need to ensure they have your correct mailing address on file. Property tax bills have a nasty habit of getting lost or sent to the previous owner. But the county doesn't care. Ignorance is not an excuse. If you don't pay your property taxes, they can and will eventually seize and sell your land. Set up a separate savings account and automatically deposit a portion of the estimated annual tax bill into it each month. When the bill arrives, the money is already there. No surprises, no panic. Now let's talk about access. If your property is on a public, county-maintained road, congratulations. If not, you need to understand the legal status of the road you use to get there. Is it a private road with a shared maintenance agreement? Is it a deeded easement across a neighbor's property? You need a copy of that easement agreement. Read it. Understand its terms. Are you responsible for a portion of the upkeep? Are there restrictions on its use? I heard a horror story about a guy who bought 40 acres accessed by a friendly easement across a neighbor's farm, only to have the farm sell to a new owner who hated the idea of anyone driving past his house. It turned into a legal nightmare that cost tens of thousands of dollars to resolve. Your right to access your own property should be ironclad and in writing. With the boundaries marked, the neighbors met, and the paperwork sorted, now you can start to dream again. But this time you dream with data. If you're planning to build, this is the time to get a percolation test, or perk test, to determine if the soil is suitable for a septic system. No perk, no permit. No permit, no house. It's that simple. If you plan to drill a well, talk to local well drillers. They have logs of nearly every well they've ever drilled in the area, and can give you a shockingly accurate estimate of how deep you'll have to go to hit good water, and what it's likely to cost. This is also the time to go back to the county planning and zoning department. This time you're not a prospective buyer. You're a taxpayer. You're one of them. Be polite, be prepared, and ask them everything. What are the setbacks? What permits are needed for a driveway, a barn, a house? Are there any future development plans for the area? The more you know, the fewer expensive surprises you'll encounter later. Buying land is not the end of a journey. It's the beginning of a relationship. A relationship with a piece of the earth that will likely outlast you. It's a commitment to be a steward, a caretaker. It will challenge you in ways you never expected. You'll deal with invasive weeds, fallen trees, drainage problems, and wildlife that doesn't respect your property lines. You'll spend money you didn't budget for and time you didn't think you had. But you will also experience moments of profound peace and satisfaction that are impossible to find anywhere else. You'll watch a sunset paint the sky in colors you didn't know existed. From a vantage point that is yours and yours alone. You'll plant a tree and watch it grow over the years, a living testament to your presence. You'll build a fire pit, a garden, a small cabin, or a sprawling home. And with every swing of the hammer, you'll be pouring your own soul into the soil. This whole process, this labyrinth of financing, appraisals, and paperwork, it's just the gate. It's the price of admission. What lies on the other side is a blank canvas. It's the freedom to create a life of your own design on your own terms. It's a tangible piece of the American dream that you can walk on, that you can touch, that you can pass down to your children. It's about more than just owning dirt. It's about owning your future. It's about putting down roots, literally and figuratively, in a world that feels increasingly transient. It's about building a legacy. So yes, the process is hard. It's complicated. It's intimidating. But is it worth it? Every single signature, every single dollar, every single sleepless night. Absolutely. Welcome home.